Welcome to Tax Breaks. I'm your host, Kelly Phillips Erb. I'm a senior writer for Forbes, and you might have seen me around the web as Tax Girl. I'm also a tax attorney, and I work with taxpayers and tax professionals like you every day. There's a lot to talk about, so let's get started. The big news this week was the stock markets. U.S. stocks tumbled as traders grappled with the consequences of President Donald Trump's tariffs. The S&P 500, a stock market index which tracks the stock performance of the 500 leading companies in the United States, hit a record high on February 19th, but dropped quickly following the announcement about the tariffs, the second fastest drop, only lagging behind the drop due to COVID. Stocks powered back after Trump announced the 90-day reprieve on most tariffs, but then dropped again. Investors felt like they had motion sickness after one of the most volatile periods on record for Wall Street. Losing money inside your brokerage or retirement account may hurt, but it doesn't necessarily mean a loss for federal income tax purposes. Markets go up and down. It's the nature of the beast. And when the market goes down, it doesn't actually mean an actual loss or a realized loss for tax purposes, even though it may hurt. Similarly, when the market goes back up, that doesn't equal a real or realized gain for income tax purposes. For tax purposes, gains and losses aren't determined moment to moment or from those highs and lows, but for how much your cost basis has gone up or down from when you acquired the asset to when you dispose of the asset. To realize a loss or a gain for tax purposes, you have to do something with the asset. And typically that means that you sell it or otherwise dispose of it. If you hold on to it, even if the market is going up or down really quickly, there's no tax consequence. Things were equally as hectic at the IRS. A Treasury announcement confirmed that Melanie Krause, the acting IRS commissioner, would be leaving her position. The announcement followed the news that the tax agency had agreed to share data with Immigrations and Customs Enforcement, or ICE. Under the agreement, the IRS will verify names and addresses of immigrants that provided tax records. That information would be provided by the IRS to ICE. It's unclear what other information would be provided by the IRS. However, an initial lawsuit suggests that it could include data such as dependents and other personal information. Krause stepped in as acting commissioner in March, following the departure of then acting IRS Commissioner Doug O'Donnell. O'Donnell had only served in the role for a few short weeks, following the departure of IRS Commissioner Danny Werfel, who departed the agency on January 20, 2025, just 1 week after the tax season officially kicked off. O'Donnell's departure on February 28 marked a remarkable 39-day span of rotating commissioners. Krause becomes the third commissioner or acting commissioner to leave the agency in less than 80 days. The IRS is also bracing for more cuts in its workforce. Thousands of agency employees are expected to receive pink slips in mid-May, about a month after tax day, April 15. About 11,000 cuts are predicted, bringing the total loss of employees at the agency in the first half of 2025 to 20,000. With a few days left before tax day, cracks were already showing at the IRS. Millions of taxpayers were expected to file their federal income tax returns by the end of the day on April 15, with millions more expected to file for an extension. It's not the ideal time for mistakes to appear on the IRS website, but that's precisely what happened. Potentially confusing errors popped up on the site, including one that impacted taxpayers filing for an extension. Specifically, the extension payment date for taxpayers who logged into the IRS website was incorrect. While payments should have been made by April 15, 2025, taxpayers who logged in saw an April 22nd due date. The site said, quote, "Your payment is due April 22nd, 2025, regardless of filing for an extension," end quote. And no, I didn't misspeak. The word regardless actually appears on the IRS website too. Multiple other errors appeared on the site, including misidentifying the amended tax form as Form 104X. It's actually Form 1040X that was recently filled instead of filed. The mistakes prompted Wendy Marsden, a CPA and author, to quip on Blue Sky. "This is feeling like the website is spoofed and your payments will go straight to Russia." It would be funny if it weren't true. The timing raised eyebrows so close to tax day. It's not clear when those changes were made. So far, there's been no answer from the agency. However, just before the mistakes were discovered on Wednesday, Elon Musk tweeted out on X, formerly Twitter, that the Department of Government Efficiency, or DOGE, had made a fix to the IRS website. Multiple tax professionals and some groups have reached out to the IRS. The IRS confirmed that it is investigating. As we look ahead, here's hoping that things aren't quite so exciting. Now, let's answer some taxpayer questions. Our first question comes from a taxpayer who participated in our Reddit AMA, Ask Me Anything tax discussion. The taxpayer asked, I seriously do not understand tax returns and when you do or do not get a tax refund. I owed the federal government thousands of dollars this year that I do not have. This has never happened before. Can you explain why this might be the case? Here's my answer. It's hard to tell without seeing your tax return, but I have a couple of guesses. First, more Americans have a side hustle these days. That means more money, yay, but it also means that you may have self-employment income, what you'd get reported on a Form 1099. With a regular paycheck and a W-2 job, you typically have withholding in the form of Social Security and Medicare or payroll taxes, as well as federal income tax withholding. But when you get a Form 1099, you won't have any withholding. Not only will you not have income tax withholding, but you won't have those payroll tax withholdings either. And not only do you still have to pay the income tax on that money, you have to pay the Social Security and Medicare, those payroll taxes. And the worst part, with the W-2, you pay half of the total payroll tax, and your employer pays the other half. With the 1099, you pay both sides, which can easily increase your total tax due. A second reason, under withholding because of your Form W-4. You complete Form W-4 and give it to your employer, not to the IRS, so that your employer can figure out how much federal income tax to withhold from your pay. It's good to look at it every year and make sure it's right. If something's changed, like you added another job, got married, or had a child, you may need to adjust your withholding. But taxpayers often don't make these changes, which could mean you're not having enough withholding taken out of your paycheck. The IRS has a tool on its website that can help you figure out exactly how much to withhold. The AMA Tax was hosted by Forbes earlier in the season. We hope to have a few more of these, so watch for details. Here's another question. A taxpayer asked, I can't pay my taxes in full. Can I pay with a credit card? You can definitely pay your taxes with a credit card, either online at the IRS website or over the phone. But should you? That's a bit more complicated. I'm generally not a fan of replacing one kind of debt with another. But if your ability to pay is a timing issue as opposed to an I absolutely don't have this at all issue, it can make sense to use a credit card to pay off your tax debt. The IRS accepts all major credit cards, including American Express, Discover, MasterCard, and Visa. To make a payment, just head over to the credit card payment page on the IRS website and choose one of the payment processors to pay online. Or you can call IRS and pay over the phone. The IRS doesn't charge a fee for credit card payments. However, third-party credit card providers may charge a fee, which changes according to provider, card type, and payment amount. Applicable fees for credit cards range from 1.75% to 2.95%. Minimum fees apply, and that's in addition to any fees or interest that your own bank can charge. High dollar payments, those over $1 million, must be coordinated with the service provider. And you may also need a new tax preparer, just saying. Paying by credit card is a good option if you know that you can pay off the bill eventually. Plus, you can earn some miles or points to help you book a trip somewhere amazing to help lessen the pain of having to pay those taxes. That's the plus side. On the not so plus side, credit card interest and fees can add up quickly. So if you know that you won't be able to pay off the balance, then consider other options, like an installment agreement with the IRS. An installment agreement allows you to pay what you owe over time. Depending on how much you owe, you may not even have to speak with a real person at IRS. If you owe $50,000 or less in combined tax, interest, and penalties, you can just sign up for an installment agreement online. If you don't qualify for the online installment agreement, or if you want to apply by mail, use Form 9465. Fees do apply, And keep in mind that it's cheaper if you sign up online, and even less expensive if you agree to pay what you owe by direct debit. Other options may be available too. If you are insolvent or otherwise unable to pay a bill because of circumstances that are beyond your control, the IRS will work with you. Give them a call at 1-800-829-1040 or use the number that's found on any notice that you might have received in the mail regarding your bill. If you have a tax question or matter that you think we should cover in the next episode, let us know. You can find more information in the show notes. Of course, if you follow me on Forbes, you know that I love looking at statistics or a good chart or a map. This week, I'm focusing on e-filing. IRS numbers from the 10th week of the filing season, that's the week ending April 4th, 2025, suggest that taxpayers are finally ready to file their tax returns. The data shows that the IRS has received 101,422,000 individual income tax returns as of April 4th, 2025. That's compared to 101,849,000 as of April 5th, 2024. That dip is pretty small, just 0.4%, and that represents about 427,000 fewer individual income tax returns filed to date in 2025 as compared to 2024. Most of those returns were e-filed. In 2025, the IRS received 98,184,000 e-filed returns compared to 98,421,000 in 2024. That's a drop of just 0.2%. Of those, the IRS reported that it received 53,392,000 individual income tax returns that were e-filed by tax professionals and 44,792,000 that were self-prepared. Most tax professionals will e-file your return. Not only are some required to e-file, but the IRS says that e-filing is secure and more likely to be accurate. As National Taxpayer Advocate Aaron Collins put it when recommending e-filing, paper is the IRS's kryptonite. While a few weeks ago, the number of e-filed returns prepared by tax professionals was nearly neck and neck with the number of self-prepared returns, tax preparers now have the edge. Taxpayers with simple returns often e-file early, while those taxpayers with more complicated returns tend to rely on their tax professionals to file, and that tends to happen later in the season. The IRS began the e-file program in 1986 as part of a pilot project in 3 cities: Cincinnati, Ohio, Phoenix, Arizona, and Raleigh-Durham, North Carolina. That year, there were 25,000 tax returns filed electronically. Last year, however, the IRS received 151,781,000 electronically filed individual tax returns. Now it's time for a little tax trivia. Who released an album titled The IRS Tapes, Fooled by My Memories, to help pay off his tax debts? Your choices are A, Chuck Berry, B, Johnny Cash, C, Willie Nelson, D, Prince. I'll give you a minute. The answer is C, Willie Nelson. In the 1980s, Nelson was hit with a staggering $16.7 million tax bill, thanks to his involvement in tax shelters. It was one of the largest individual federal income tax bills ever generated by the IRS at the time. The debt was negotiated to a mere $6 million by Nelson's lawyer, but Nelson still didn't have the money to pay. On November the 9th, 1990, the feds raided Nelson's home, taking everything he owned except Trigger, Nelson's favorite guitar, which he had his daughter Lana take out of his home in anticipation of the raid. As long as I got my guitar, Nelson said, I'll be fine. The IRS auctioned off some of Nelson's belongings, but it didn't dent Nelson's tax bill. So the two sides reached a rather unusual compromise. Nelson would release a compilation album and would share the proceeds with the IRS. The album, called IRS Tapes, Fooled by My Memories, was entirely written by Nelson and recorded with, what else, Nelson's trusty guitar, Trigger. The IRS only collected $3.6 million from the sale of the album. However, by that time, Nelson had settled his lawsuit with Pricewaterhouse, who he blamed for his tax problems in the first place. And with some other projects in the works, Nelson was able to pay off his debt. An IRS spokesperson said about the deal at the time, "We try to work with taxpayers, and if we have to come up with some creative payment plan, that's what we're going to do because it's in everyone's best interest." Now it's time for a deeper dive, and it's a look at tariffs. Admit it, you haven't heard about tariffs this much since freshman U.S. history class. But with tariffs on again and off again, it's all that many businesses are talking about. One of the motivations behind the tariffs is revenue. Peter Navarro, a senior White House trade official, projected that tariffs announced since January would generate between $6 and $7 trillion worth of income over 10 years. They'll generate enough revenue to fund an extension of the 2017 Tax Cuts and Jobs Act, or TCJA, plus some of Trump's campaign promises, including tax-free tips, tax-free overtime, and tax-free Social Security benefits. However, according to a new Tax Policy Center estimate, the tariffs will generate far less tax revenue than the administration claims. TPC estimates that Trump's taxes on imported goods would raise about $3.3 trillion from 2026 to 2035, plus an additional $190 billion for the remainder of 2025, roughly half of Navarro's prediction. Of course, that was before the pause. That and raising import taxes on Chinese goods would cut in half the amount of revenue that Trump's April 2nd levies could increase, according to a new TPC analysis. TPC found Trump's latest plan would raise $1.7 trillion from the 10 years starting 2026 through 2035, plus an additional $125 billion for the remainder of 2025. The analysis assumed that Trump's latest tariff policy would be permanent, although he said that his newly announced delay would only last 90 days. It also assumed that the president would eliminate his reciprocal import taxes, but continue his 10% tariff on worldwide trade and maintain higher tariffs on many goods from Canada and Mexico, and on products such as steel, aluminum, and autos and auto parts, as well as raise tariffs on Chinese goods to 145%. Trump has suggested that the tariff revenue could replace income tax revenue. Earlier this year, he mused that the IRS could be replaced by an external revenue service, a new government agency that could be established to oversee the collection of tariff revenue. While abolishing the IRS and eliminating income taxes may sound good to some taxpayers, the practicality of fully replacing tax revenue with tariff revenue is very complex. And while most of the current tariffs and revenue raisers are focused on China, tariffs targeted to Canada have raised eyebrows. Trump has suggested that there's an easy fix, writing on Truth Social, quote, "The only thing that makes sense is for Canada to become our cherished 51st state. This would make all tariffs and everything else totally disappear," end quote. Those comments have rankled Canadian politicians, including Canada's new Prime Minister, Mark Carney, who said, quote, "The old relationship we had with the United States, based on deepening integration of our economies and tight security and military cooperation, is over. It's clear that the U.S. is no longer a reliable partner," end quote. And while it's easy to dismiss this back and forth as political grandstanding, this isn't the first time that the U.S. has weaponized tariffs. In the late 19th century, President Benjamin Harrison's Secretary of State, James G. Blaine, had a plan. By saddling Canadian imports with heavy new tariffs, the United States could force Canada to seek American statehood. Will history repeat itself? Spoiler alert, the 1890 tariffs didn't result in Canada becoming what would have been, at the time, our 45th state. And now for something a little more brief, some quick tax and accounting newsmakers. In a letter to Senate Majority Leader John Thune and Senator Catherine Cortez Masto, the American Institute of CPAs, or AICPA, commended the leadership of these two senators on behalf of American businesses and employees through the introduction of the bipartisan Mobile Workforce State Income Tax Simplification Act of 2025. This bill, with a very long name, provides uniformity for non-resident state and local income tax withholding, and a reasonable de minimis exception from assessing state and local income tax in a jurisdiction where an employee does not reside. This has become a big issue in a post-COVID world. Remember last week when I wrote that Italy believed that it could tax social media? Lawmakers in Minnesota think so too. Key Minnesota Democrats on legislative tax committees want popular social media platforms to pay tax on the use of consumer data. Under the bill, large companies with more than 1 million users in Minnesota would pay $165,000 per month plus 50 cents per person on the sites, while those with fewer than 100,000 users would not pay any tax. Those in the middle would pay varied rates. Facebook, which is owned by Meta, is considered to be the largest social media platform in the world, with over 3 billion monthly active users. YouTube is the second most used social media platform, with around 2.49 billion monthly active users. And that's a wrap. Thank you to those who continue to watch, comment, and share the show. I'd love to know what you thought about this episode. You can send an email with your feedback to kerb@forbes.com. And if you liked it, please share. You can find a link to the audio of each episode on Forbes.com. And thanks for listening, because paying taxes is painful, but hearing about them shouldn't have to be.